Welcome to Griffonomics.
Glad to be here for this one. It's a really fascinating topic today.
It really is. I mean, what if I told you the world's largest corporate consulting firm just spent over $1 billion buying, like, a website that tests your home Wi-Fi speed?
Yeah, when you see that headline, it makes zero sense at first glance.
Exactly. So today we are doing a deep dive into the earnings reports, the strategic announcements, and the M&A forensics of Accenture ticker symbol ACN. We're trying to figure out exactly why they did that.
Right, because we are looking at how a gigantic labor-based IT consultancy, a company historically famous for basically renting out human brain power by the hour, is fundamentally transforming.
Yeah, transforming into what they call an AI-powered reinvention platform.
Sure.
And whether you're an investor looking at tech stocks or just a professional trying to figure out how AI actually makes money in the real world, this matters to you.
Absolutely. Beneath all the corporate buzzwords, there is a very real, very high-stakes business realignment happening right now on their balance sheet.
Which brings us to the big question, right? So, is AI going to cannibalize the consulting industry, or is it the ultimate growth engine?
That is the trillion-dollar question hanging over the entire market.
So let's start with that.
Yeah.
The paradox haunting the market right now. In our sources, there's this pervasive idea, the cannibalization narrative.
Right, the fear that AI just wipes out their business model.
Exactly. The logic is, if an advanced AI tool can do the heavy lifting of, say, coding and data analysis, the need for armies of human consultants just vanishes. I mean, I saw a note from a partner highlighting how AI can reduce a massive SAP migration from 6 months of work down to, like, 2 weeks.
Which sounds like a disaster for a company that bills by the hour.
Right. If a tool is that wildly efficient, doesn't that just absolutely destroy billable hours?
It does, and that's the exact fear driving a lot of market skepticism. But when you dig into the analyst notes from firms like UBS and Wells Fargo, they are explicitly calling this cannibalization fear overblown.
Overblown.
Well, generative AI isn't shrinking their pie. It's acting as a massive growth enhancer. UBS is actually projecting that this AI integration will add 250 to 300 basis points to Accenture's annual growth.
Wait, really? 300 basis points. You're talking about adding an extra 3% of pure gross to a massive, mature, global consultancy just from AI efficiency.
Yeah, exactly.
How does finishing a project in 2 weeks instead of 6 months lead to more overall revenue? I mean, mathematically, that feels backwards.
I know, but you have to think about the prerequisites. To even deploy advanced AI, a company first needs a pristine, modernized digital foundation.
Okay, so the groundwork.
Right. You can't just plug a brilliant language model into some messy, outdated legacy mainframe from like 2005 and expect it to magically optimize your supply chain. It just doesn't work.
So generative AI is acting as a forcing function. It's the shiny object that forces companies to finally gut renovate their entire digital house.
Precisely. It's driving an immense wave of demand for foundational data and cloud modernization. It unlocks these massive infrastructure projects that clients previously thought were just, well, too complex or cost prohibitive to even attempt.
Okay, that makes sense. And to handle that level of renovation, Accenture has restructured into what they call their unified reinvention architecture.
Right. They completely changed their internal operating model.
Yeah, they took their previously distinct department strategy, consulting, technology, operations, Song, which is their digital marketing wing, and Industry X, their digital manufacturing wing, and just integrated them into a single AI delivery model.
Because they realized that in the AI era, siloing your expertise is fatal. If you have an AI solution for a manufacturing problem, it doesn't just need a software engineer.
It needs everyone.
Exactly. It requires business strategy, operational change management, and digital manufacturing expertise all working simultaneously. And this integrated approach is where Accenture's sheer scale shifts from being, a sluggish liability to a massive competitive advantage.
Because they have a workforce of 786,000 people.
Yeah.
I mean, they took an army the size of Seattle, broke down their department walls, and retrained them on a single platform.
And they just announced they have over 85,000 dedicated AI and data professionals, which actually hits their 2026 talent goal early.
Wow, already?
Yeah, and they deploy this massive workforce across two main revenue pillars. You've got consulting, which handles the modernization and change management, and managed services, which runs the ongoing maintenance and operations.
Okay, but let me throw an analogy at you.
Yeah.
Traditional consulting is kind of like paying for a taxi by the minute, right?
Sure.
So if AI is this bullet train that gets you the destination way faster, Isn't Accenture losing out on the per minute fare? I mean, how do they actually survive that transition financially?
Well, that leads directly to the core financial mechanism that protects them. If they finish a 6-month project in 2 weeks, charging the client by the hour would bankrupt them. So they had to change how they bill.
Oh, the fixed price pivot we saw in the Q2 data.
Exactly. This is arguably the most important metric in their entire earnings report. Over 60% of Accenture's work has now moved to fixed price contracts.
Up from 50% in 2023. So they just quote a flat rate now.
Right. Instead of the classic full-time equivalent or FTE model where they charge you for 50 consultants at an hourly rate until the job is done, they transition to outcome-based pricing. They say, we will migrate your system for a flat fee of $10 million.
Oh, wow. So if Accenture uses their proprietary AI to finish that $10 million job in half the time with half the human staff, they capture the entire financial upside.
Yep, 100%.
They don't pass the savings back to the client in the form of fewer billable hours. Their own profit margins just explode.
Precisely. And for the client, this fixed price model provides ultimate cost and delivery certainty, which is highly prized right now. But for Accenture, it completely insulates them from seat-based pricing pressure. They're decoupling revenue growth from headcount.
But to pull that off, they need to actually own the underlying technology and data, right? Not just rent the people.
Right, which explains the massive jump in their capital allocation. They recently raised their full-year M&A guidance, their budget for mergers and acquisitions, from $3 billion to a staggering $5 billion.
And they're aggressively targeting non-FTE, high-margin revenue streams, which brings us back to that billion-dollar Wi-Fi speed test I mentioned earlier.
The Ookla acquisition.
Yeah. Wait, the speed is people. Why on earth is a corporate consulting firm spending $1.2 billion on a website that tells me my home Wi-Fi is slow?
I know it looks bizarre on the surface, but you have to look at the raw data Ookla controls. It's not just a consumer website, it is a global engine for proprietary network intelligence.
What kind of intelligence?
Well, every single time someone runs a speed test or reports an outage on Down Detector, Ookla captures incredibly granular data. We're talking network performance, latency, device capabilities, and connectivity infrastructure across the entire globe.
Oh, so they are buying the underlying data pipeline, not a consumer brand.
Exactly. And that data pipeline generated $231 million in 2025 revenue entirely through high-margin subscription models. Ookla sells this real-time network intelligence to massive telecom operators and governments.
Okay, but how does that connect to AI?
Well, as Accenture deploys AI systems into physical infrastructure, think smart electrical grids or robotic manufacturing through their Industry X division, those AI models require absolute real-time certainty about network latency to function safely.
Ah, so Accenture is buying the proprietary data sets that their AI models need to survive in the physical world. It's basically moving into services as software.
Exactly. They're selling intellectual property and data licenses rather than just human hours. And they are complementing that with pure talent acquisitions too, like the faculty deal.
Right, they purchased that UK-based AI native firm that brought in over 400 specialized AI professionals, like elite data scientists.
Yeah.
But the craziest part was they took faculty CEO, Dr. Mark Warner, and immediately made him Accenture's new global chief technology officer.
Yeah, you do not buy a boutique AI firm and instantly install its founder as your global CTO unless you are executing a foundational shift in your corporate DNA. They are injecting pure AI-native architectural thinking directly into the C-suite.
Okay, so they have the talent, they have the data pipelines, and they've insulated their margins with fixed-price contracts. Let's look at how this actually functions for the client, because the sources mention a transition from basic chatbots to something called Agentic AI.
Right. We are rapidly moving past the era where AI just answers a typed question. Agentic AI refers to autonomous software agents that can reason, formulate a multi-step plan, and actively execute tasks across various systems.
Without a human clicking approve at every step.
Exactly. No human intervention needed for the routine steps.
Let's take that out of the theoretical for a second. How does an autonomous agent actually generate revenue? Our sources highlight their alliance with Microsoft, launching a forward-deployed engineering practice. And they use the Radisson Hotel Group as an example.
The Radisson case study perfectly illustrates this. First, Accenture had to do the foundational work. They modernized Radisson's entire digital infrastructure. Once that plumbing was fixed, they deployed agentic AI into their marketing operations.
Okay, so historically, a human marketing team looks at yesterday's data,
Yeah.
has a meeting, and decides on tomorrow's ad spend.
Right, which inherently lags behind real-time events.
Hmm.
The agentic AI completely changes that latency. These autonomous agents dynamically optimize marketing content based on real-time traveler intent.
So if the AI detects, say, a sudden weather event causing flight cancellations,
It can instantly spin up targeted ad copy for stranded travelers, identify the best channels to reach them, and autonomously shift marketing budget from a different campaign to fund it on the fly.
wow, the software is making financial decisions and executing strategy autonomously. And they're co-developing similar systems with Microsoft for cyber defense,
Well,
right? Autonomous agents hunting threats.
yes, but, and this is a big but, that level of autonomy introduces a massive bottleneck for a specific tier of Accenture's clients. Radisson might be fine running algorithms on the public cloud, but Accenture deals heavily with European governments and defense contractors.
Right. Which leads us to sovereign AI. Let me try an analogy here. If public cloud AI is like a massive, highly efficient public library where everyone shares resources, sovereign AI is like an ultra-secure, off-the-grid VIP room at a Swiss bank, right?
That analogy captures the legal reality perfectly.
Why isn't public cloud good enough for these specific European governments?
Because the regulatory and national security risks are immense. They cannot simply upload classified defense schematics into a public generative AI model hosted in another jurisdiction.
Right.
For these clients, data sovereignty is a strict, non-negotiable legal mandate under frameworks like GDPR.
So the data literally cannot legally leave the country's physical borders.
Exactly. To solve that, Accenture partnered with Palantir and the French AI company Mistral AI to build physical sovereign AI data centers across EMEA Europe, the Middle East, and Africa.
That are literally using Dell AI factories and NVIDIA chips to build the physical infrastructure.
And the architecture's brilliant. Palantir provides the highly secure software layer, Mistral provides the powerful localized AI models, and Accenture provides the industry integration.
So heavily regulated industries get cutting-edge AI, but with uncompromised control over their data residency. That's a huge competitive moat. A new tech startup simply cannot replicate building secure fortresses for foreign governments overnight.
No, they can't. It's a massive barrier to entry.
Okay, so if this fixed price, highly secure AI-driven model is actually working, it should show up as massive cash flow. Let's look at the financial realities. Do the Q2 2026 numbers actually prove this thesis?
They really do. The second quarter numbers are uniquely strong. They reported $18.04 billion in revenue, which is up 8% in US dollars. But the true indicator of the strategic success is the bookings metric.
The $22.1 billion in new bookings.
Yes, a record $22.1 billion.
That gives them a robust book-to-bill ratio of 1.2. Meaning for every dollar they're billing today, they are booking $1.20 in new contracted work for tomorrow. That's a massive backlog of future revenue.
It proves client demand is significantly outpacing their current output. And the scale of these deals, they had a record 41 different clients sign deals exceeding $100 million in a single quarter.
41 nine-figure contracts in 3 months. That is insane C-suite trust, and that translates directly to the balance sheet. They reported a record $3.7 billion in quarterly free cash flow.
Which gives management an incredible amount of leverage. They're generating so much cash, they confidently raised their full-year free cash flow guidance by a full $1 billion.
Up to, what, 10.8 to 11.5 billion for the year.
Exactly. That cash flow means they can aggressively buy back shares and fully fund that $5 billion M&A war chest we discussed, all without taking on toxic debt.
But, gravity applies to every company. We have to objectively look at the hidden landmines here. Record bookings are great, but there are headwinds, right?
Yes, there are specific headwinds investors must account for. First, the U.S. federal business is currently acting as a 2% drag on their overall growth in the Americas. Management expects it to recover by Q4, but it's a tangible negative right now.
And digging into the 10Q filing, that federal issue gets more complicated. Now, we are just reporting the objective facts from the filings here. We aren't taking sides or making assumptions about guilt. But Accenture Federal Services is currently cooperating with the Department of Justice civil and criminal investigation.
Right, regarding potentially inaccurate security control submissions.
Yeah. So as a cautious investor, I have to ask, with the DOJ breathing down their neck on security controls, how much of a threat is this to their government pipeline?
The implications are significant. In federal contracting, trust and compliance are the foundational currency. Contractors must self-certify that their IT systems meet strict security standards. If there are inaccuracies, it can trigger False Claims Act violations.
And it introduces major reputational risk, especially when your core thesis involves building ultra-secure sovereign AI data centers.
Exactly. Any cloud of doubt regarding internal security controls is a headline risk that could disrupt future contract eligibility. Now, analysts currently view this as an isolated regulatory hurdle rather than a systemic failure, but it is absolutely a critical vulnerability to monitor.
Okay, so we have a really complex equation. We weigh the massive free cash flow and the fixed price pivot against the U.S. federal headwinds and the DOJ scrutiny. Which brings us to Wall Street's final verdict on the stock. It's a fascinating valuation paradox.
It really is a paradox. There's a disconnect between business performance and market sentiment. If you look at the strategic outlook from analysts at UBS and Wells Fargo, they are decisively rating the stock as an overweight or a deep buy.
Even with the federal headwinds in the DOJ investigation.
Yes,
Okay.
because they are looking at the $22.1 billion in new bookings and that massive projected cash flow. But the broader retail market and algorithmic trading funds have actually punished Accenture's stock price recently. The market has been swept up in a massive AI panic, specifically the fear that AI will replace software seats and eliminate human consulting hours.
Ah, so the market got spooked by the very cannibalization narrative we unpacked in Section 1.
Exactly. Algorithms often lump IT services together with pure software companies. So when software seats get cut across the industry because of AI, Accenture gets punished by proxy in the ETFs, creating this artificial discount.
Because the algorithms don't read the contract structures, showing that 60% of Accenture's revenue is now fixed price and immune to that exact disruption.
Precisely. The market is aggressively pricing in the fear of disruption, while the analysts are seeing a company that is actually leading and profiting from it. As a result, UBS points out that Accenture is trading at its lowest forward earnings multiple in more than a decade.
And for the first time in recent history, it is trading at a discount to the broader S&P 500, a decade-low entry point for a company that just raised its free cash flow guidance by $1 billion.
It's a remarkable setup.
It really encapsulates the core lesson of this entire deep dive. Accenture is utilizing its massive balance sheet and its 786,000 employees to pull off a fundamental metamorphosis. They're successfully transitioning from a company that sells people's time into a company that sells AI-driven outcomes.
They recognize that the future of their industry was about capturing the financial value of extreme efficiency rather than allowing that efficiency to destroy their billing model.
Right. And as we wrap up, I want to leave you with a final thought to mull over. If Accenture is physically building out sovereign AI data centers in Europe with Palantir, and they are buying up proprietary global network data sets like Ookla,
And increasingly charging fixed prices for autonomous software that executes work without human intervention.
yeah, it raises a really provocative question about their identity. At what point do they cease to be a consulting firm entirely?
I mean, if a single entity owns the proprietary data pipelines, builds the physical sovereign infrastructure, and controls the autonomous software agents, they're no longer just advising businesses. They are officially transitioning into a global tech infrastructure monopoly, hiding in plain sight behind the legacy label of an IT consultancy.
A tech infrastructure monopoly dressed up in a consultant suit. And that is exactly why understanding this transformation is so essential for you. Whether you are an investor evaluating tech equities or a professional trying to future-proof your career in the knowledge economy, you need to pay attention. We are rapidly moving from a world of billing hours to a world of fixed-price AI outcomes. The old taxi meter is being ripped out, and the autonomous bullet train is already laying down new tracks.
Make sure you understand exactly how the new system operates.
Risks defined. Portfolio protected.